September 2008. Lehman Brothers filed for bankruptcy on a Monday morning. By Friday, $10 trillion in global wealth had vanished. Pension funds imploded. Mortgage markets froze. Banks refused to lend to each other overnight. Yet in a quiet trading room in Midtown Manhattan, hedge fund manager John Paulson stared at a $15 billion profit. Not despite the crash, but because of it. The instruments he used never appeared on mainstream financial TV. Most individual investors still have no idea they even exist. Conventional wisdom says, when the economy collapses, protect your capital. Go to cash, buy gold. Wait it out, survive. That thinking is exactly why ordinary investors lose twice, once in the crash, and again in the recovery when they buy back into late. Crashes don't destroy wealth. They transfer it. Always through the same 5 channels. One of those assets surged 507% in just 6 weeks during 2020. Not a single mainstream advisor mentioned it. Here are the 5 assets that quiet move money from the unprepared to the prepared. Asset 1. Long-duration sovereign bonds. Most people treat bonds like dental appointments. They know they should own some, but they'd rather not think about them. That indifference is a massive mistake. Here's the precise mechanism. When the economy cracks, central banks panic and slash interest rates. In 2008, the Fed cut rates from 5.25% to 0 in 14 months. In March 2020, they cut 150 basis points in a single emergency weekend. When rates fall, existing bonds with higher fixed coupons suddenly become extremely valuable. The math is unforgiving. A 20-year Treasury yielding 4% becomes worth far more when new bonds only yield 1%. Result? In 2008, while the S&P 500 crashed 38%, the E-shares 20-plus-year Treasury bond ETF TLT gained 33.8%. During the Great Depression, as stocks lost 89%, long-term U.S. government bonds delivered positive returns every single year for 4 straight years. The driver is deflation fear. When credit freezes, prices fall, making fixed cash flows more valuable. Capital flees stocks and floods into safe sovereign debt, driving prices sharply higher. In the 2020 COVID crash, TLT soared nearly 25% in under 6 weeks, while stocks plunged 34%. It wasn't just a hedge, it was a profit machine. The window opens when deflation panic hits and closes when central banks ignite inflation expectations. Those who recognize that window win. Asset 2. Volatility. This is the one almost nobody treats as an investable asset, and it's the most explosive. The VIX measures fear in the S&P 500 options market. In calm times it hovers around 12 to 15. In panic, it explodes. February 2020, VIX at 14. By March 18, 85.47, a 507% surge in 6 weeks. October 2008, it spiked to 89.53. You can actually own volatility through exchange-traded products like VXX or the leveraged UVXY. These instruments delivered eye-watering returns during the acute phase of the crash. John Paulson's famous 2008 trade was, at heart, a volatility bet, using credit default swaps to profit when fear in the mortgage market detonated. Volatility products decay in calm markets due to contango, which is why advisors rarely mention them. But sophisticated institutions always keep some exposure. The key is surgical timing, by when credit markets first crack, before the mainstream narrative catches up. Hold only through the fear spike, then exit. Those who timed it in early 2020 turned weeks of chaos into life-changing gains. Asset 3. Distressed debt. This is where the quietest fortunes are made. Far from dinner party conversations and Instagram infographics. When panic hits, forced sellers flood the market. Banks facing capital calls, hedge funds hit with redemptions, insurers managing regulations. They sell not based on value, but survival. In March 2020, even investment-grade corporate bonds LQD dropped nearly 20% in 3 weeks. High-yield bonds HYG fell 24%. It was pure forced liquidation. From the bottom, LQD recovered about 25% by year-end. High-yield recovered even faster, returning roughly 40% from trough to new highs within 7 months. The biggest wins come from buying individual distressed bonds or loans at 30 to 40 cents on the dollar when recovery value is 70 to 90 cents. Howard Marks of Oaktree called the 2008 distressed opportunity the best he'd seen in 30 years. His funds delivered strong double-digit annual returns. The signal is always the same. Credit spreads blow out from 300 to 400 basis points to over 1,000. The market prices in economic Armageddon. In a modern economy with a central bank that almost murdered. Asset 4. Gold. But not the way you think. Everyone thinks they understand gold. Buy it when things get scary. That advice is incomplete and often costly. In 2008, gold peaked near $1,000 in February, then fell to $720 by October, a 28% drop during the heart of the crisis. Many who bought as insurance sold at a loss. Gold's real power shows up after the acute panic, during the desperate government response. From its October 2008 low, gold climbed to $1,900 by 2011, a 164% gain. Why? Because crashes are always followed by massive money creation. The Fed's balance sheet exploded from $900 billion to $4.5 trillion. In 2020, it doubled from $4 trillion to $9 trillion in months. When governments print at that scale, every existing dollar becomes a smaller claim on real assets. Gold, which cannot be printed, rises. The lesson: don't buy gold before the crash as simple insurance. Buy it at the bottom, when central banks are clearly opening the monetary floodgates. When real rates turn deeply negative. History since 1929 confirms the pattern. Gold often lags or falls in the initial panic, then surges on the policy response. Smart investors treat gold as a bet on government desperation, and they have been proven right every single time. Asset 5. Agricultural land. While home prices fell 26%, commercial real estate dropped 30 to 40%, and stocks were cut in half during 2008-2009. U.S. farmland values rose. Between 2007 and 2012, median Iowa farmland jumped from about $3,900 per acre to $8,400, a 115% gain. Farmland isn't just real estate. It's a productive asset that generates food, something people need no matter how broken the financial system becomes. During crises, supply chains fracture and food prices become volatile. But demand for food is completely inelastic. You can skip a new car or vacation. You cannot skip eating. In the Great Depression, farmers who owned their land outright kept food security, while much of the country suffered. Farmland is the most orthogonal asset on this list. It depends on soil, water, and biology, not central banks, derivatives, or legal systems. Of course, it has risks, illiquidity, and potential political interference in some jurisdictions. But, owned outright in a stable country, producing exportable crops, it has proven extraordinarily resilient across centuries of financial turmoil. It won't triple in a quarter like volatility, but it compounds over decades. Precisely because crises destroy paper claims, while preserving the ability to feed people. Closing, every major crash in the last century has proven the same truth. Wealth is not destroyed, it is transferred. It moves from the panic and unprepared to those who understand these 5 channels. Long-duration bonds that surge on deflation fear. Volatility that explodes when fear peaks. Distressed debt bought at pennies on the recovery dollar. Gold that shines brightest during the monetary aftermath. And productive farmland that quietly endures. The investors who profited most in 2008 and 2020 weren't necessarily smarter or better connected. They were simply prepared. Every crash is called unprecedented by those it destroys, and entirely predictable by those positioned ahead of time. The difference has never been intelligence. It has always been preparation. The next crash is coming. The only real question is, which side of the wealth transfer will you be on?